The HECM program must be financially viable. What does that imply for both the short and long-term outlook of the HECM program?
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
As an industry press member, HECM World attended NORML's virtual annual meeting just last week. Deputy Secretary of Housing and Urban Development and former FHA Commissioner Bryant Montgomery attended, and his comments reinforce a common theme that we've heard since 2009, viability. Referencing the continued strong demographic demand for the home equity conversion mortgage, Montgomery said, "So long as the program is built to be viable," and then he added, "In the end, we must protect seniors who depend on the HECM while ensuring our program's financial strength can endure market cycles without taxpayers picking up the bill." In the effort to avoid the HECM requiring further subsidies and to remain economically viable, in the past, HUD and FHA have an established history of relying on a couple of levers to help reduce future risk of claims or insurance payouts, and that is reducing principal limit factors and, of course, restructuring FHA mortgage insurance premiums. Other measures do include the elimination of HECM products, the addition of a financial underwriting requirement, and, of course, reducing the interest rate floor. Now, weeks following the much unwelcomed October 2017 HECM principal limit factor cuts, one industry leader at that time pointed to unaddressed problems in the quote-unquote back end of the program. More specifically, at that time, there was a backlog of unprocessed HECM loan assignments, and that months prior to the appointment of then FHA Commissioner Bryant Montgomery. In May 2019, Montgomery did announce some good news that the backlog of HECM claim assignments had been cleared up, and he also expressed cautious optimism of the program's future financial viability. Now, while industry watchers were certainly grateful that logjam of assignments had been eventually cleared, they still expressed some continued concerns of servicing issues, that from HUD's appointed national servicer, citing that there is abandoned properties being left, unauthorized occupancy of homes by relatives, children, or even being subletted, and then the deterioration of HECM properties with REOs or real estate owned properties, sometimes for months or years. However, in the short term, we do have some good news. That is strong home appreciation throughout the fiscal year 2020 and, of course, low interest rates. Higher home values increase the equity buffer between a HECM loan's balance and the asset or home value, and the low interest rates, of course, slow that gap being closed by accrued interest and negative amortization. And knowing that those economic conditions will significantly improve the HECM's present net present value, it is logical to conclude that we are facing significant risks. That is, should the housing market erode in the coming year. Now, in his presentation last week, Montgomery cautioned, while I believe there are positive effects of both our policies and a robust housing market, the coronavirus and loss of employment has produced serious headwinds. We know that pro-cyclical forces can provide a false sense of security. He also referenced stress testing. Now, a stress test is when you measure how a bank, corporation, or the FHA insurance fund would potentially perform under several potential economic scenarios. And that would, of course, necessitate modeling some negative what-if events, which would include increasing interest rates, falling home values. And one number that would be an asset when we do stress test the HECM, at least this year, is the HPA, that is the home price appreciation rate. Now, the average quarterly HPA from 2011 to 2019 was 1%, or an adjusted average of a 4% annual home appreciation rate. Now, 2020 home values are certain to push that number significantly higher. The HECM has numerous challenges when you attempt to determine its economic viability and its value. And its valuation and future claim payouts are extremely sensitive to appreciation or deflation in interest rates. Now, for a better idea of the HECM program's current economic viability, here is a short summary of HUD's annual report to Congress, which was released just this last Friday.
The reverse mortgage may be just a minuscule portion of the overall FHA portfolio, but it is not forgotten. As evidenced by this quote, over the last 3 years, FHA has taken several actions to improve the HECM portfolio's outlook. However, it continues to be a financial drag on the forward portfolio. The forward portfolio's positive performance in effect subsidizes the HECM book of loans. FHA will continue to take steps to stabilize the HECM program for borrowers and taxpayers. The question is, what will those steps be? Much of our discussion in the annual report centers on valuations, but there is a lot of interesting data about the home equity conversion mortgage. Case in point, HECM claims by type. Now, type 1 are properties that are unoccupied or sold for a loss, and type 2 are those that have been put into HECM assignment. So you can see the dramatic change in the type 1 and type 2 claims in recent years. Next is the average maximum claim amount for FHA-endorsed home equity conversion mortgages. This would seem to indicate two things: increases in the maximum claim amount or the national lending limit, and second, an appreciation in home values. HECM refinances, it's no secret, are on the rise. This chart shows the growth in the maximum claim amount and HECM refinances as a percentage of that when compared to traditional and also purchase transactions for home equity conversion mortgage loans. Do you remember when fixed rate HECMs were all the rage? Well, they may have been the source of many of our losses and drain on the HECM portion of the MMI fund. This shows the dramatic switch between product preference and also availability. The impact of principal limit factor cuts in the October 2013 Reverse Mortgage Stabilization Act and also the infamous October 2017 principal limit cuts can be seen in this chart. As with most mortgage transactions, consumer behavior is shaped by product availability. And when we had the standard fixed rate eliminated and also the preponderance of HECM fixed rates left the market, we can see that the average cash draw or principal limit also was subsequently reduced. As we know, the estimation of the net present value of the HECM program is highly volatile. Here's a comparison between fiscal years 2019 and 2020 with claims paying capacity and the program's net present value. This chart perhaps represents one of the best overviews of our industry when it comes to product choice, the type of transaction, and overall endorsement volume totals for years 2009 through 20.
Well, thanks again for watching. If you do enjoy these weekly updates, the best way that you can thank us is to share this video with both your traditional or forward mortgage friends and, of course, your reverse mortgage colleagues. We would certainly appreciate it if you do. Let us know your thoughts on the financial viability of the HECM program and also the most recent report to Congress on the HECM. You can do that in the comment section below. Have a great week and be sure to return next Monday for more reverse mortgage news, commentary, and analysis here at HECM World.